So, welcome back to this session for CS Professional, Financial, Treasury and Forex Management Revision class. In the last lecture, we revised the concept of time value of money and capital budgeting. And today we are targeting to have leverages, cost of capital, and capital structure theories in our agenda. So here I am starting with leverages. Before we discuss anything about leverage, we need to go through some of the basic concepts of marginal costing. What is variable cost? Variable cost is variable and fixed cost is fixed. You may be thinking, oh, this is something really very simple. Yes, variable cost is variable and fixed cost is fixed in total. But variable cost is fixed and fixed cost is variable in per unit terms. This is a very simple concept, but when it comes to application of this concept in leverages chapter, many students make a mistake. So yes, this is very simple, but still you need to keep in mind that variable cost is variable and fixed cost is fixed if we are talking about the total amount, and variable cost is fixed and fixed cost is variable if we are talking about per unit cost. Now the next thing is what is contribution? It is sales minus variable cost. If you want to calculate contribution per unit, it's selling price minus variable cost per unit. If you want to calculate PV ratio, that is profit volume ratio, it is contribution divided by sales multiplied by 100. Even if you calculate it per unit, still it will be same. Contribution per unit divided by selling price multiplied by 100. How do I calculate break-even point? Look, example I'll quickly give if you wish. Say, for example, okay, I'll put it here. Say, for example, your contribution is 40,000 rupees. And sales is 1 lakh rupees. And then you multiply it by 100. And it equal to 40% PV ratio. This can also be done in per unit terms. Like contribution per unit is rupees 4, selling price per unit is rupees 10, multiplied by 100 is equal to 40%. Once you calculate the profit volume ratio, then the next thing is the break-even point. Break-even point may be calculated either in terms of units or in terms of total amount. What is break-even point? It is the quantity of sales at which the profit is zero. That is, contribution is equal to fixed cost. So break-even point is equal to fixed cost divided by contribution per unit. Say fixed cost is 1 lakh rupees, or let's say fixed cost is 40,000 rupees, and contribution per unit is say 4 rupees. What does it mean? 10,000 rupees, 10,000 units is your break-even point. Suppose I am into the business of manufacturing and selling stationery. So I manufacture this pen and cost to manufacture this pen is rupees 6, while selling price of this pen is rupees 10. What does it mean? I'm getting a profit of rupees 4, which is actually named as contribution per unit. By manufacturing and selling one pen, I'm getting contribution of 4 rupees. But I've got a factory setup and there I need to pay some fixed cost like supervisor salary, rent of the factory, some other expenses. So 40,000 rupees per month is my fixed expense. And by selling one pen, I get a contribution of 4 rupees only. So that way my break-even point is 10,000 units. Cost 10,000 units selling for myself. First 10,000 unit I'm selling to pay the fixed cost. One can also calculate break-even in terms of rupees. So there are two ways. BP in terms of units is 10,000. Selling price is rupees 10. So that way 1 lakh rupees will become your break-even point. Or the other way around is 40,000 is the fixed cost. You divide it by the PV ratio, which is 40%, 0.40. And then you solve it 1 lakh rupees. I'll slightly change this example. Say this 2 lakh and this is 80,000. Fine. Then the next two things are margin of safety in terms of rupees and margin of safety in terms of percentage. So suppose my sales is 2 lakh rupees and my BP is 1 lakh rupees. What is margin of safety? It is amount of sales above the break-even point. Break-even point is 1 lakh rupees. My total sales is 2 lakh rupees. So that way I have got margin of safety of 1 lakh rupees. And then here comes margin of safety in terms of percentage. So you already know that margin of safety in terms of rupees is 1 lakh rupees. And total sales is 2 lakh, then you multiply it by 100 and you'll get 50%. What is 50%? Even if the sales reduces by 50% from its current level, still I will not sustain a loss. The sales drops by 10, 20, 30, 40%, fine. Even if it reduces by 50%, I won't have the loss. But if it reduces by more than 50%, say 60%, in that case, I'll sustain a loss. So these are the basic concepts you need to know before you try to attempt leverage. Now, what is leverage? So let me tell you, leverage is nothing but disproportionate change. Whenever any activity causes disproportionate change, there must be some leverage behind it. So the sales is doubled and your profit is tripled. Or sales is made 2 times and your EPS rises to 4 times. This kind of disproportionate change is actually named as leverage. You know what is leverage? Leverage is tendency of disproportionate change. Leverages are of 3 types: operating leverage, financial leverage, and the total leverage or combined leverage. So I'll take one example and I'll try and explain it to you. Just a minute. Share one Excel file with you. Okay, it's right here. That's great. Now, okay, so here I go. So my sales is, say, 20,000 units into rupees 10 per unit. That is 2 lakh rupees. Variable cost at the rate of 6 rupees. 20,000 into 6. It is 1,20,000. When I deduct it, I'll get contribution. So contribution is 80,000 rupees. Then I deduct fixed cost. and fixed cost is say 40,000 rupees. So that way, actually, I'll get profit. This profit is before interest and tax. And that's why it is named as EBIT, earning before interest and tax, EBIT. This EBIT is 40,000 rupees. Okay, now tell me one thing. Suppose if I increase the amount of sales, what will happen to variable cost is 12,000 rupees. No, it's 1,20,000. It is 20,000 multiplied by 6 because units are 20,000. Variable cost is 1,20,000. Okay, so if I increase the amount of sales, what do you think? What will happen to EBIT? The amount of sales, what will happen to EBIT? Yes, EBIT will also increase. And if I reduce the amount of sales, what will happen to EBIT? EBIT will also reduce. Exactly. If I double the amount of sales, what will happen to EBIT? Will it also be doubled? No, not actually. If I increase sales, EBIT will increase. If I decrease sales, EBIT will decrease. But if I double the amount of sales, EBIT will not be actually doubled. You know, because if I double sales, contribution will also be doubled, but fixed cost will remain same, and that will cause disproportionate change in EBIT. So if I take sales equal to 4 lakh, then variable cost is 2,40,000, then contribution is 1,60,000, and fixed cost will remain same as before, that is 40,000. So EBIT will become 1,20,000. So if I double the amount of sales, amount of EBIT is tripled, and this disproportionate change is actually named as leverage. And here this disproportionate change is caused by fixed cost. And better I can name it as operating fixed cost. It does not include interest or dividend. And that's why I will name it as operating fixed cost. And that's why this leverage is named as operating leverage. How do you measure the leverage? So there is a formula, and the formula says that degree of operating leverage. Degree means extent, measurement, which may be named as DOL. And this DOL is actually equal to percentage change in EBIT divided by, just a moment please. Hello? Achha. Thank you. Okay, so there is a message that rather than studying till 11, today we will conclude at 10:45. That was the message. All right, 15 minutes less, no worry. Percentage change in EBIT divided by percentage change in sales. That's the formula. So if I calculate what is the percentage change in sales, and percentage change in EBIT. So sales increased by 100%. 2 lakh plus 2 lakh is 4 lakh. And EBIT increased by 200%. There is increase of 80,000 rupees on the base of 40,000 rupees. That is 200%. So this is 200 divided by 100. And that is actually 2 times. Okay. This 2 is not 2% or 2 rupees. This 2 is simply 2 times. Okay. Now, what is the advantage of making this calculation? Advantage of making this calculation is that from the current level of sales, that is 2 lakh rupees, whatever change, you can't hear me? Okay. Allow me to check it. I'm not sure why this is happening. Give me a minute, please. Is it clear? Okay. Okay. So other people are able clearly. Okay. Please check at your end the internet connectivity. Other people are able to hear me properly. Great. So look here. What does this 2 means? It simply means that if the amount of from the current level of sales, whatever change you EBIT will change by 2 times. Like here, if you reduce sales by 10%, EBIT will reduce by 20%. Say if I make sales equal to 1,80,000, then variable cost will also reduce by 10% and it will become 1,08,000. So contribution will also reduce by 10%. It will become 72,000. Fixed cost will remain same, 40,000. So in that case, my profit EBIT will come to 30,000. And profit actually reduced by 8,000 rupees on the base of 40,000 rupees. That is 20% downfall. See, this 10% downfall in sales, it is causing 20% downfall in EBIT. So moral of the story is, from the current level of sales, whatever change you make in sales, EBIT will change by double the percent. Okay, great. But there is a shortcut also to calculate this degree of operating leverage. And the shortcut formula is DOL is equal to contribution divided by contribution minus fixed cost. And the beauty of this formula, you don't need 2 columns for amount. You can calculate DOL with the starting point itself. So at the base level where we are starting, contribution is actually 80,000 rupees divided by contribution 80,000 minus fixed cost 40,000. And when I do solve it, it will be actually equal to 2 times 80,000 divided by 40,000. So now that's a shortcut to calculate degree of operating leverage. Okay. If I continue this income statement and suppose I deduct interest and say the amount of interest is 10,000. So it remain 10,000 in either case. When I deduct interest, I'll get profit before tax. And profit before tax is 30,000 and 1,10,000. Then I deduct tax. And suppose tax rate is say 30%. So I'll just calculate 30% of this figure. It is 9,000 and 33,000. Then I'll get profit after tax. And this profit after tax is 21,000 and 77,000. Then I'll suppose deduct dividend on preferential, or let's say there are no dividend on preferential. DP, I'll write it as DP. Just for the sake of simplicity, say dividend on preferential is actually 0. Okay. So now I'll get earning available to equity shareholders. EAES is actually earning available to equity shareholders. So that's 21,000 and 77,000. I will divide it by number of equity shares. So suppose number of equity shares are 10,000. So finally, I'll get EPS. It's EAES divided by number of equity shares. That is EPS. And now you can observe that there is a disproportionate change in EPS also. Earlier, the leverage, that is the disproportionate change, was caused by fixed cost only because it was fixed. But now there are 3 items which are creating leverage. One is fixed cost, other one is interest, and the third one will be dividend on preferential, which is in current case 0. Whatever fixed items are there will cause leverage. Operating fixed cost, interest, preferentials. So if I want to calculate degree of financial leverage and degree of total leverage, look, how do I do that? I'll simply say the degree of financial leverage, which may be named as DFL, is the percentage change in EPS with respect to percentage change in EBIT. Mind it, relationship between sales and EBIT is named as operating leverage, and relationship between EBIT and EPS is named as financial leverage. So here, if I try to calculate the percentage change, look, EBIT is going up from 40,000 to 1,20,000. That is a 200% change. And EPS, if I calculate, percentage change, I'll calculate in this column. Calculating percentage change is simple. I'll take 7.7 minus 2.1 multiplied by 100 and then divided by the base number 2.1, 267%. I will copy it here also. See, sales is rising by 100%, EBIT is rising by 200%, EPS is rising by 267%. So here I should put 267%. And the answer is 1.33 is the degree of financial leverage. Now there is a shortcut formula to calculate degree of financial leverage. And that formula is degree of financial leverage is equal to EBIT divided by EBIT minus interest. In this case, EBIT is 40,000 and interest is 10,000. Is it? So that is 40,000 upon 30,000. That means 1.33. You know, this is the shortcut formula when there are no preference shares. But if there are preference shares, then actually the shortcut formula will change a little bit. And in that case, the shortcut formula will actually look like this. Exactly like this. It's gonna be EBIT divided by EBIT minus interest. Then you should also deduct dividend on preference shares. Dividend on preference shares, and dividend on preference shares should be divided by 1 minus the tax rate. So if I quickly create this example for with dividend on preference shares also, you know, in that case, say dividend on preference share is also 10,000 rupees. So then EPS will be 1.1 and 6.7, and the percentage change in EPS will be 509.09. So I'll have to put it like this, 509.0909. Okay. And then I will calculate DFL, and then DFL will be 2.54. But if I calculate it with the shortcut formula, then besides 10,000, I'll have to further deduct 10,000 for dividend on preference share, and that should be divided by 1 minus tax rate, that is actually 0.7. And if you try and calculate that, 2.545. So it will be EBIT upon EBIT minus interest minus dividend on preference share divided by 1 minus tax rate. What is operating leverage? It is a relationship between sales and EBIT. What is financial leverage? It is a relationship between EBIT and EPS. Then the next thing may be the total leverage. So what is total leverage? Okay, just give me a second. Okay, there is some doubt. But KP is considered after tax now. Anjali, this is not. See, I intentionally reduced the font. Just give me 5 minutes time. It was already zoomed in to a great level, but I need to type further things. And that's why I zoomed it out. KP is after tax. No, this is not KP. This is DP, dividend on preference share. Here you will have to put the amount of dividend on preference share. We are not calculating cost of preference share. We are simply deducting the amount of dividend on preference share. And as you are saying, it is after tax. Yes, it is after tax. First we deducted tax, and thereafter we deducted dividend on preference shares. And yes, that's why we treat it after tax. That's the reason. Okay. Now, if I want to calculate degree of total leverage, which is a relationship between sales and EPS, then how does it look like? I'll tell you. Look, degree of total leverage Okay, can you tell me the formula? What is the percentage change formula for degree of total leverage? Come on, hurry up. Percentage change in EPS upon percentage change in sales. Exactly. You answered it right. And here, percentage change in EPS is 509 and percentage change in sales is 100. So that way, DTL will be 5.09. And if you need the shortcut formula for DTL, one of the shortcut formulas for DTL can be DOL multiplied by DFL. So in this case, DOL is actually 2 times multiplied by 2.545. That will give you 5.09. This is the shortcut formula for DTL. Now there is one more shortcut formula for DTL, and that shortcut formula will look like this. Contribution upon contribution minus fixed cost minus interest minus dividend on preferential, and dividend on preferential is divided by 1 minus tax rate. So this is one more. There are 3 formulas to calculate the degree of total leverage. Now this is an overview of what is DOL, DFL and DTL. Now let's talk about interpretation of these numbers. Look, if I talk about DOL, then DOL is actually a measure of business risk of the company. You know how? I'll give you one very interesting relationship over here. If you try to recall the formula for margin of safety, what is the formula for margin of safety? Margin of safety in terms of percentage is actually equal to sales minus break-even point divided by sales into 100. That's okay. Now I'm making one change to this formula, and I'm saying that let's multiply this by PV ratio and then divided by PV ratio. So you know what will happen in the numerator? It will be sales multiplied by PV ratio. You know what is sales multiplied by PV ratio? Sales multiplied by PV ratio is actually contribution. And also it will be BP multiplied by profit volume ratio. And break-even point multiplied by profit volume ratio is actually equal to fixed cost. Exactly, Priyanka. That's right. So if I rewrite this formula, you know, this will be sales into PV ratio is contribution minus BP into PV ratio is actually fixed cost divided by ratio. This is also equal to contribution. And do you know what is the formula for degree of operating leverage? Formula for degree of operating leverage is equal to contribution upon contribution minus fixed cost. Right? So what do you see over here? What is degree of operating leverage? What is degree of operating leverage? It is equal to 1 divided by margin of safety. Higher the margin of safety, lower the degree of operating leverage, and vice versa. So that's a fantastic relationship between margin of safety and the degree of operating leverage. Okay. So now if I explore what is DOL, DOL measures business risk. Higher the DOL, higher the business risk, and vice versa. Look here. If margin of safety rises, what does it mean? Your business risk actually falls. If margin of safety rises, then your business risk actually fall down. On the other hand, if margin of safety rises, then DOL is equal to 1 upon margin of safety. So DOL also falls. Similarly, if margin of safety falls, it means your sales reduces, you come near, this is the break-even point, this is your sales. So your sales reduces and come near to the break-even point, then your margin of safety actually reduces. When margin of safety reduces, then business risk rises. On the other hand, if margin of safety falls, then DOL rises. Moral of the story, look here, the shaded area. Higher the DOL, higher the business risk. Lower the DOL, lower the business risk. So what is DOL doing? It is measuring business risk. If DOL is higher, business risk is higher. If DOL is lower, business risk is also lower. So if I ask you that DOL, is it preferable on higher side or is it preferable on lower side? Look, let me explain it here. If DOL is higher, degree of operating leverage is higher, then MOS is lower. It means that sales is lower. It means that profit is also lower. If DOL is higher, then MOS is lower. It means that sales is lower. It means that profit is also lower. And risk is higher. And you know, the risk is higher because DOL is higher. So higher DOL means number one, higher risk, and number two, lower profit. And vice versa. What does that mean? If DOL is lower, business risk is lower. If DOL is lower, then margin of safety is higher, sales is higher, profit is higher. So what do you say? How would you prefer the DOL to be? Can you tell me? Would you like the lower DOL or the higher DOL? Yes, exactly. DOL should be lower. That's right. Okay, then let's talk about the financial leverage. Now, financial leverage is not as simple. Interpretation of financial leverage is not as simple as that of the operating leverage. Financial leverage measures financial risk. Higher the DFL, higher the financial risk. just like DOL. Higher DOL means higher business risk. Here also, higher DFL means higher financial risk. If DFL is say 3, what does it mean? That if EBIT rises by 10%, EPS will rise by 30%. But if EBIT falls by 10%, then EPS will fall by 30%. Now the question arises, how would you prefer the DFL to be? So here there is one very interesting relationship, and that is relationship between ROI and interest rate. Okay. You know, if ROI is more than interest rate, ROI stands for return on investment. So allow me to give you one example which will help us in capital structure decisions also. So now I'm creating one example which will be helpful in DFL as well as in capital structure decisions. Suppose you have 2 alternative plans to raise fund. Look, DFL is dependent on interest and dividend on preferentials, and interest and dividend on preferential is dependent on capital structure of the company. That is, how do the company actually raise fund? Suppose you have 2 choices. You can issue equity shares of rupees 10 each for 2 lakh rupees and 10% debentures of 0 rupees, or you can issue equity shares for rupees 1 lakh and debentures for rupees 1 lakh, because your total capital employed requirement is actually equal to 2 lakh rupees. You need 2 lakh rupees for doing business, and there are 2 choices. Say either you can be a pure equity company or you can be a partially debt company. I must tell you here formula for ROI or ROCE, whatever you call it. Both are same thing, return on investment or return on capital employed. And the formula is actually EBIT divided by capital employed. Or if I rewrite the formula, I can say that capital employed multiplied by ROI will give me EBIT. In this case, capital employed is 2 lakh rupees, and say ROI in the type of business we are doing is 15%. So that way, our EBIT will be 30,000 rupees. So you are going to start a new business where the capital investment requirement is 2 lakh rupees and where the rate of return in the business is expected to be 15%. So that way you actually expect EBIT of rupees 30,000. That is at the ROI of 15%. Here I have assumed that ROI is equal to 15%. And accordingly, this 2 lakh rupees multiplied by 15%, and here also this 2 lakh rupees multiplied by 15%. This is the EBIT. So, you know, here now we are not starting with sales minus variable cost minus fixed cost equal to EBIT. As we are analyzing DFL, so we need to explore relationship between EBIT and EPS. And that's why I'm starting with EBIT. Then I deduct interest. So interest in this case is 10,000 rupees. But in first case, it will be 0 because you have not issued any debentures. In second case, it is 10,000. Profit before tax is 30,000 and 20,000. Then I charge tax. Suppose at the rate of 25%. So tax will be 7,500 and 5,000 rupees. Or let's make it 40%. That will make our calculation easier to understand. So profit after tax is actually 18,000 and 12,000. Once I get profit after tax, then I need to deduct dividend on preferential, which is not here. So now I'll simply divide it by number of equity shares. Number of equity shares in the first case is 20,000 equity shares, and in second case these are just 10,000 equity shares. And here I'll get EPS, and EPS is profit after tax divided by number of share. It is 0.9 and 1.2. Just observe this carefully, and then I'll give you one very fantastic analysis of degree of financial leverage. Megha, capital budgeting only ARR method was pending. So ARR I can explain you anytime in 5 minutes. If time allows later, then I will cover it. I'm covering only key areas. You know, within a period of 9 hours, 50% of the syllabus cannot be covered. So I'm focusing on the areas which are actually difficult or important from the point of view of examination also. So if some of the things are left, better to leave it. Still, if time allows at the end of the last session, we'll try to cover it. Okay, guys. So here I go. Now you can observe one thing. This EPS in plan 1 is 0.9 and EPS in plan 2 is 1.2. Look, you're earning 2 lakh rupees. You're earning 30,000 rupees, which is actually 15% return, right? %15% you are earning, and on that you are paying 40% tax. So if I try to calculate ROI, which is after tax, then it will be 15% into 0.6. That will be actually 9%. My ROI is 15%. In first plan, there is no advantage of tax benefit on interest. So I earn 15%. I pay 40% taxes. So I am left with 60% of my. That is, my earning is 9%. And that's why you can see that here the face value of the share is rupees 10 and 9% is your profit. So 10 rupees multiplied by 9% is actually 90 paisa. This is the reconciliation, okay? But here in this case, you're getting 1.2 as EPS. You know why? Look, on this 10% debenture of 1 lakh rupees, you have promised to pay interest at the rate of 10%. And when this money is invested in the business, your ROI is, so you will earn 15% and you will pay just 10%. 5% will be the surplus. You borrowed money at the rate of 10%. You're investing it at the rate of 15%. Surplus left is 5%. Can you tell me to whom this surplus belongs to? Does it belong to Government of India, Income Tax Department? Or it belongs to the equity shareholders? Or it belongs to the debenture holders? Or it belongs to director promoter? Hello, come on, answer it. My question is, in your organization, in your business, you bought money at 10%, you borrowed money at 10%, you invested at 15%, 5% surplus is there. Yes, Aarti, exactly. This 5% surplus actually belongs to equity shareholders. That's perfectly correct. So without investing further amount, equity shareholders will be getting this 5% surplus. Look, number one, equity shareholders are earning 1 lakh rupees multiplied by 15%, that is 15%. So plan 2 EPS. Now I am calculating in a different manner. Look, 1 lakh rupees is the amount of equity on which you will be earning 15% ROI. So 15,000 is one thing. Number two, 1 lakh rupees is the amount of debt on which you are earning 15, but you are paying just 10%. So this 5,000 also belongs to equity shareholders. Now equity shareholders are earning 15,000 of their own earning and 5,000 of the surplus from debenture holders. So now they are earning 20,000 rupees. But after paying tax, they will be left with 60% amount only. So that is actually 12,000 rupees. And this 12,000 rupees, they are earning on their investment of 1 lakh rupees. That is 12%. So return on equity in case of plan 2 is 12%. And on 10 rupees of the share, if you calculate 12%, it is EPS of 1.2. Should I repeat it quickly? Look, equity shareholders are earning 15% on their 1 lakh. That is 15,000. Plus equity shareholders are getting 5% surplus on the amount borrowed rupees 1 lakh. That is 5,000. They are earning total 20,000 rupees. But 40% is tax, so they will be earning 12,000. 12,000 they are earning on equity investment of 1 lakh. So the return on equity is actually 12%. And that's why this EPS is 1.2. Can I say, okay, if I calculate here DFL also, degree of financial leverage. And you know the shortcut for DFL is EBIT divided by EBIT minus interest. So I will say EBIT here is 30,000 divided by EBIT 30,000 minus interest is, here in this case it is 0. So DFL is 1 and 1.5. So I will say this is low risk and this is high risk. Lower the DFL, lower the financial risk, and higher the DFL, higher the financial risk. But taking this risk is actually worthwhile, because if you are taking higher risk, in that case you are getting higher EPS also. But you cannot conclude that I should take further risk. I should reduce equity share to 50,000 rupees and increase the debt level to 150. or further reduce equity to just 10,000 rupees and make the debt level equal to, 1,90,000 rupees. Now, the leverage is a double-edged sword. If it is working in your favor, it can also work against you. In the current scenario, ROI is more than interest rate, and therefore higher leverage is actually favoring equity holders. What if this ROI reduces to 8%? Then you will be earning 8% and you will have to pay interest at the rate of 10%, and there will be a deficiency of 2%, and that deficiency will have to be borne by equity shareholders, and loan will actually become a problem for you. So finally, I can conclude it like this. If debt equity ratio increases, DFL also increases, but in that case, impact on EPS is dependent on ROI. If ROI is more than interest rate, then EPS will also increase due to advantage of trading on equity. You are paying 10% interest, you are earning 15% ROI, 5% surplus is named as advantage of trading on equity. In this case, higher amount of debt is actually preferable. But if ROI is less than interest rate, in that case, there will be disadvantage of trading on equity, and EPS will reduce if you borrow more amount. If ROI is equal to interest rate, then the amount of debt in your capital structure will not affect the EPS, and EPS will remain same. In the real life, the problem is ROI does not remain constant. Sales keeps on fluctuating. Therefore, EBIT also fluctuates. Therefore, ROI also fluctuates. And sometimes ROI even becomes lower than your interest rate. So it is not really sure that ROI will always remain more than interest rate. Sometimes it can come below interest rate also. Like in the current COVID-19 pandemic, the sales of many corporations dropped almost to zero, and therefore their EBIT has gone negative. And those who have borrowed money, they are in big trouble because they are not in a position to pay interest, and the lender can file insolvency suit against them and they can go out of business. And those who are purely working on equity, even in this tough situation of COVID-19, they will survive. Like recently, Reliance Industries Limited made itself debt free. What is the advantage? Even in the bad times, when sales is lower, EBIT is lower, ROI is grounded, still you are not in tension because you don't have to make payment of interest. You need not to make repayment of debt. You're purely financed by equity. Equity dividend is not compulsorily to be given. And redemption of equity is never a pressure. It is irredeemable. So that way, lower debt is favorable in tough situation. But higher debt is preferable when the economy is doing good. But the economy keeps on fluctuating. So what should I do? You should think that you should have a moderate level of debt, so that on one hand you can take advantage of trading on equity, and on other hand, in tough times you can still survive. Okay, so that is the interpretation of DFL. Combined leverage is just the multiplication of operating leverage and financial leverage. As far as comments on combined leverage is concerned, it's here. DTL measures, total risk. If DTL is say 5, what does it mean? 1% change in sales will make 5% change in EPS. Sales reduces by 10%, EPS will reduce by 50% and vice versa. As DTL is the multiplication of DOL and DFL, so if both DOL and DFL are low, then DTL will also be very low. But in this case, if you don't take risk at all, you won't be able to take advantage of trading on equity. If both business risk and financial risk are high, then your total risk will be very high. Say DOL is 4, DFL is also 4, then DTL will be 16. That much high risk is not preferable. If business risk is high and financial risk is low, in this case, though the total risk will be moderate, but this is also a bad combination because high business risk and low financial risk is just opposite what we want. The ideal combination is your business risk should be low and your financial risk should be high. Low business risk means higher EBIT, and high financial risk means you can take advantage of trading on equity. Your total risk will be moderate and your return will be very high. So with this, I conclude the chapter leverages. Okay, probably you need a very short break of 2-3 minutes. So let's take a break of 2 minutes, 3 minutes, and then we will start it again. So here we go. So many students are asking, where can we get your notes? It's available publicly. My notes are publicly available. You can visit fmbytm.com and install my mobile application. And in the mobile application, you will find many useful notes. How can we ask doubts? You can ask doubts, students. My number is also available over there. You can WhatsApp me your doubts later. Okay, so here we go with our next chapter. That is capital structure and cost of capital. Please, your mobile application. I said it is fmbytm.com, fmbytm.com. Hey, come on, guys. Let's focus on what we are studying now. Am I audible? Okay, that's great. So here we go with the cost of capital chapter. You know, a finance manager has to take three major decisions. Number one is investment decision. Number two is financing decision. And number three is dividend decision. What is investment decision? Look, that's very simple. Where should I make investment of my money? So capital budgeting decisions are considered to be investment decisions. What are financing decisions? From where should I bring in money to support my business? That is the financing decision. And in this chapter, we are going to study that only. You know, there are two things. One is capital employed and other one is capital structure. I need 10 lakh rupees for my business. That is capital employed. Now, there are various possible mixture of various sources of finance that I can create for this 10 lakh rupees. That is actually capital structure. Say I procure entire amount of 10 lakh from equity shares. That is one capital structure. Or 5 lakh rupees of equity and 5 lakh rupees of debt. That is second capital structure. Or say 4 lakh rupees of equity, 4 lakh rupees of preferential and 2 lakh rupees of debt. That's another mix of various sources. That's the third capital structure. So capital employed means the total amount invested in the business, and capital structure refers to the mix of various sources of finance within that capital employed. Now a question arises, what mix is most suitable for my business? You know, if you plan to finance your business purely by equity, then there is a great problem that you will lose control, because those people, equity shareholders to whom you issue equity shares, they will start to vote. Okay, in that case, I'll try to purely finance it by debt. In that case, your interest burden will reduce and your financial risk, your DFL, will be very high. More equity, loss of control. More debt, higher financial risk. So, sir, what should I do then? Don't go for pure equity or pure debt or pure preference or pure any source company. Rather than make a mix of various sources of finance. So you will have some control, your risk will remain within limits, and the most important thing which decides your capital structure is the cost of capital. That is the sources from where I will raise fund. The sources from where I will raise fund should actually be cheaper sources of finance. I need to consider risk, I need to consider control, and at the same time, the most important thing I need to consider is the cost of capital. So, if the cost of capital is on the lower side, then that is fantastic. Okay, so how do I calculate cost of capital? Now that's a question. Just a minute. How do I calculate cost of capital? So what is the definition of cost of capital? It is nothing but expectations of investors. I hope the Word file I am seeing on my screen, you're also able to see that. Okay, good. Usually people say that whatever I pay to my investors is my cost. No, not. Cost of capital is nothing but the expectations of investors. Better I say it is the expectation of stakeholders, means the investors, brokers, underwriters, Government of India for taxes. Their expectation together from the company is actually the cost of capital. There are two ways to calculate cost of capital. One is to do it with trial and error method, and the other one is to do it with the shortcut formula. How do I do it with trial and error method? Okay, I'll tell you that. You know, in FM, there is a concept which says that value is equal to performance of the company divided by expectation of investors. If company is performing good, value will be high. If investors are expecting even higher, then value will actually be low. For example, suppose a company has issued a 4 years bond and company has promised the face value of the bond is 1,000 rupees and the coupon rate offered by the company is 10%. So 1,000 rupees into 10%, company will be paying interest of 100 rupees each year. And at the end of 4th year, the debenture will actually mature. So besides coupon of 100 rupees, company will also be paying redemption price of 1,000 rupees. So these are the cash flows which are actually outflows for the company, but this amount is actually inflow for the company. Now suppose expectation of investor, better I say desired rate of return. Desired rate of return of investor, suppose it is equal to 12%. Company is performing 10%. Investor is expecting 12%. You know, without making the calculation, I can assure you that the fair value of this bond must be at a discount because performance is just 10% and expectation is 12%. And that's why without making any calculation, I can tell you that the fair value of this bond must be at a discount. Now, if I try to calculate the fair value, I'll have to calculate present value. And present value will be definitely calculated at the rate of 12%. You already know the calculator keystrokes. I taught you in time value of money. So I'm not going to repeat it now. Okay. Calculator keystrokes, I'm not going to repeat. When I calculate present value of all these cash flows, it is like this. Or if you want more accurate answer, I can say up to 2 decimal places. And then I make a total. So this is actually fair value of the bond. You see, I told you that it should be quoted at discount because expectation is more than performance. But you know, in cost of capital chapter, we will be doing reverse calculation. Now, what do I mean that we will be doing reverse calculation? I mean that we will do it like this. Expectation is equal to performance divided by value. So suppose if the question says that a company has issued 10% coupon bonds for 4 years maturity, face value is rupees 1,000. Current fair value of the bond is 939 rupees. What is expectation of investors? Oh my God. So expectation of investors is actually missing, and I need to find that out. I don't know the rate, so I'll have to do trial and error and interpolation. So like company will be receiving 939.25 rupees at year 0, and it will be paying 100 rupees of interest for each of the 4 years, and then it will be redeeming the bond at 1100 rupees. So what does it mean? Look, this is very simple, that I know the value 939, I know the performance is this 1100, 100 and 1100. So what is expectation of investor? If I want to find out, that expectation will be actually my cost of capital also. Because whatever they expect, it is returned to them, but it is cost to me. Return to investor is cost to the company. So to know this rate at which NPV will be 0, this is nothing but IRR. You will have to do trial and error and interpolation. But okay, here I'll help you with the ready-made answer, that this IRR is actually equal to exactly 12%. Do the trial and error interpolation and you will come to know that investors are actually expecting 12%. But if somebody tells you that, look, besides this, company will have to pay underwriting commission and brokerage of 5 rupees per debenture. Company will have to pay underwriting commission and brokerage of 5 rupees per debenture. So it will not realize 939, it will realize only 934 rupees at year 0. So then if I calculate IRR, it is 12.17%. So the cost of capital to the company is 12.17%. But sir, IRR is the income. No. IRR can be income as well as cost. You know how? It's very simple. If I make initial outflow and then I get series of inflows, then IRR will be my income. But if I initially receive or borrow something and then I make a series of payments, then the IRR will be cost. If I borrow and make series of payments, repayments, then IRR will be my cost. So if the cost rises from 12% to 12.17%, investors are expecting still 12%, and plus the intermediaries like brokers are expecting 12. They are expecting a commission. So my cost has gone up to 12.17. Then somebody reminds me that income tax is 30%. So this 100 rupees of interest will actually cost you just 70 rupees, because you will be getting tax benefit on interest. Then I again calculate IRR and my IRR becomes 9.03%. And this is actually my cost of debt. Cost of any source of finance, whether it is debenture or preferential or equity share or anything else. Cost of any source of finance can be calculated with this IRR formula, with trial and error interpolation concept. Okay. But what if I don't want to do this trial and error exercise? In that case, there are ready-made formulas. There are shortcut formulas for debentures, for preferentials, for redeemable securities, as well as for irredeemable securities. Like the example we recently took was redeemable debenture. So this is the shortcut formula where I won't have to do trial and error and interpolation. Here I is equal to amount of interest, which is 100 rupees. 1 minus T, so tax rate was 30%. This is 0.7. Redemption at par, 1000 rupees. P is 934.25. and number of years are 4 years, and then R is equal to 1000 and P is equal to 934.25 and then divided by 2. You know, you can do this calculation in one shot on your calculator. I can tell you how do you do this, but I think that will consume a lot of time. So let's do it quickly. In the numerator, you know, it will be 1000 minus 934.25 divided by 4 plus 70. So in the numerator, it will be 86.4375. Okay. And then in the denominator, it is 1000 plus 934.25 divided by 2. That is 967.125. Divide equal to into MRC 0.89394. So that is equal to 8.94%. Now this is the tentative answer. This is not the exact answer. Exact answer is 9.03%. But the shortcut formula won't give you the exact answer. It will give you approximate answer, and that is 8.94. That is roughly 9%. Screen is blackout for practical portion. Oh, so you're not seeing this formula, KD? Is the screen blacked out? Can you see this formula of cost of debt? Okay, it's visible. Fine, fantastic. Great. Look at it now. So this is the formula for cost of redeemable debt. If it is irredeemable debt, perpetual in nature, then you know N will become infinite. Number of years will be infinite. And there is no use of R, that is redemption price. So R and N should be eliminated from the formula, and only I, T and P will remain in the formula. And formula will become KD is equal to I into 1 minus T divided by P. Now the ditto same formula are applicable for preference shares also. Okay, so the question is, can we use this shortcut formula in examination? It is very much allowed. Yes, the answer is not accurate, but using the shortcut formula is 100% allowed in examination. In fact, even if the question insists that you should do it by trial and error, I'll say first you should do it by this formula, and at least you will have an idea that I should start my trial and error process at the rate of 9%, because you are seeing it that the rough answer is 8.94. So even if you want to do trial and error, first you can apply this formula, get the rough answer, and start trial and error accordingly. So you won't have to make more number of trials. Now the debt formula and preferential formula is exactly same, with only one difference, that in case of debt, you take amount of interest multiplied by 1 minus tax rate. But in case of preferential, you take amount of dividend only. You don't multiply it by 1 minus tax rate. Can you tell me why don't you multiply amount of dividend by 1 minus tax rate? Exactly, because amount of dividend is not deductible for the purpose of income tax. So these are the shortcut formulas, and these are very much allowed to be used in examination. Now, There are two limitations of the shortcut formula. If the difference between redemption price and the net proceeds realized, that is issue price, is more, then the accuracy of shortcut formula will be very low. Like here, here if I apply the shortcut formula also, and in 2-3 steps if I'll solve it, first I'll do I into 1 minus T. So amount of interest is 100 rupees, and then I multiply it by 0.7, it is 70. Then the R minus P divided by N portion. Just a minute. Just give me a minute. First, I'll give you some inputs. Suppose R is 1000. Suppose I is 100. Say T is 30%. And say P is 934.25. So now I'll quickly give you two ways to calculate it. Just a second, please. I'm trying to create one example for you. Just a minute. Okay. So this is the trial and error result. And if I use the shortcut formula, then the result should look like this. It starts with interest multiplied by 1 minus tax rate. So interest multiplied by 1 minus tax rate is this, plus R minus P upon N. So this is R is 1000 minus P is 934 divided by, just a minute, number of years are 4. R minus P divided by N is like this, and plus divided by R plus P by 2. So this should be just a second. So with the shortcut formula, final answer should look like this. .94%. Okay. But suppose if I change this to 800 rupees, and here the difference is minute, 9.03 and 8.94%. But if I make it 800 rupees, see what will happen. If I make it 800, the difference has gone up by around 0.5%. And suppose if this is 600 rupees, then the trial and error method is giving you answer of 23.48%, and shortcut formula is giving you 21.25%. So if the difference between R and P rises, say this is 400. Now in this case, the trial and error method is giving you 38% as the answer, and shortcut formula is giving you 31% as the answer. So there is a huge difference. When the difference between R and P rises, then the accuracy of shortcut formula actually reduces drastically. So moral of the story is, in that case, one should avoid the shortcut formula if there is a huge difference between R and P, and rather solve the question with trial and error method. Also, in case of gradual redemption of debenture, like the 1,000 rupees debenture, principal amount repaid will be 250 rupees each year, and coupon will be paid on the outstanding balance. If that is the situation, in that case also your formula, shortcut formula fails. Shortcut formula fails in two situations: if the difference between R and P is higher, and if the bonds are to be redeemed gradually, step by step. In that case also the shortcut formula will actually fail. So in those two cases, one should avoid the shortcut formula and better to use the full trial and error method. This was for the shortcut for cost of debt and cost of preferential. Now let's talk about shortcut for cost of equity. The proper method for any source is the trial and error interpolation method. In case of equity, we actually have 5 approaches. In case of debentures and preferentials, in case of debentures, you pay fixed amount of interest each year. In case of preferential, you pay fixed amount of dividend. But in case of equity share, no fixed dividend is given, and the life of equity is also not fixed. So it's not easy to figure out the cost of equity actually. And there are 5 approaches. One is dividend capitalization approach, then the earning capitalization approach, then there is growth approach, and then there is realized yield approach. And then there is one more approach which is actually named as the capital asset pricing model, which is considered to be the best. As I told you, in this chapter we are doing reverse calculation. We know that value is equal to performance divided by expectation. But if value is given, if performance is given as a balancing figure, we can calculate expectation. So all these formulas are actually not cost calculation formulas. Rather than these are actually valuation formulas. If a company is expected to give constant dividend in future, in that case, the valuation formula is like this. Just a minute. The original, I'm sorry, I'll type it here. Original formula is like this. Value of the equity share, that is equal to amount of dividend divided by cost of equity. Value is equal to performance divided by expectation. Value is P. Performance is the amount of dividend. And KE is the expectation of equity shareholder. Try to recall that the formula for present value of perpetuity is equal to A divided by R. So here A is actually D and R is actually KE. This formula is nothing but the formula for calculation of present value of perpetuity. So if a company is expected to give fixed amount of dividend on equity shares forever, then dividend will form a perpetuity, and that's why this valuation formula P is equal to D divided by K. But actually we shuffle this formula and we make it a cost of equity formula. Originally it's a valuation formula, but we are using it in the reverse fashion. So this formula actually becomes KE is equal to D divided by P, and it is based on P is equal to D divided by K. Okay, this formula, this valuation formula is actually used when dividend is expected to be constant forever. But if a company is expected to have variable dividend and constant earning per share forever, then the valuation formula is value is equal to performance upon expectation. P is equal to EPS divided by KE. If I reverse the formula, it becomes cost of equity is equal to EPS upon P. Never ever think that cost of equity is dependent on price. If price rises, cost of equity reduces. No, never. It never happens. Actually, if cost of equity rises, then price of equity share reduces. K is neither dependent on D nor dependent on P. We are just making the reverse calculation. Keep in mind always. If dividend is constant, this is the valuation formula. If earning is constant, this is the valuation formula. You reverse it and you make it cost formula. But if a company is expected to give growing dividend, in that case, the valuation formula is like this. This is actually formula for present value of growing perpetuity. Present value of growing perpetuity. Present value of perpetuity is A upon R. Present value of growing perpetuity formula is A1 upon R minus G. So A1 means D1 and R means K and G is the growth rate. So why growth is actually deducted? Look, there is a whole derivation behind this formula. You cannot try to interpret this formula by just looking here that what is the logic. You can't get the logic here. There is a whole derivation. So better to believe in this formula. So fair value of equity share is equal to the amount of dividend for the first year. Here D was just D, but in this formula, I'm putting D1. Reason, here D is constant, whether it is D1, D2, D3, every time the amount is constant. And here the dividend is growing by a constant rate. So D1 is there and then D2 will be higher and D3 will be further higher. Cost of equity is nothing but expectation of equity shareholders and G is the growth rate. When you shuffle this formula, it becomes the KE formula. KE is equal to D1 upon P0 plus G. Okay. Now, look, realized yield approach, I'll tell you later. It's not that important. We can even skip this. Here what is D1? D1 is dividend at the end of first year. If D1 is not given in the question, then they will give D0. That is the current dividend. So you take D0 and multiply it by 1 plus growth rate. Suppose D0 is 5 rupees. Suppose growth rate is 10%. Can you tell me D1? Please type your answer in the chat box. Suppose D0 is 5 rupees. 0 years dividend is 5 rupees. Growth rate is 10%. So what will be D1? Yes, exactly. That will be 5.5. That is 5 rupees multiplied by 1.10. That will give you D1. Now, all these questions, they cause a whole lot of trouble. Many times it is not really easy for you to interpret that what is D0 and what is D1. So look here, how to, if they have given D0, then you will have to add growth to it to arrive at D1. But if it is already D1, then you can directly put it into the formula. How could I know that the amount given in the question is D0 or D1? Look, I have given some example. If the question says company has paid dividend of rupees 5 per share, has paid, it cannot be, D0 means current. Now, D1 means 365 days from today. So today it is 3rd of July 2020. So D1 will be on 3rd of July 2021. If dividend is paid in June 20 or it is being paid on today or it will be paid in July 20, June 20, July 20, it is D0. But June, July 21, that will be D1. Company has paid, already paid, that's D0. Company is paying, currently paying, that is also D0. Company is about to pay dividend of rupees 5 share. So this is 3rd of July. Maximum up to 10th of July, they will. Okay. Probably I lost connection. Okay, great. Okay, am I audible? Am I connected to you people? Okay. Okay, great. So look here. I was asking you one question. Now, probably we got this. I don't know how. So if I look at this question, this situation, P0 is equal to D1 upon KE minus G. Tell me one thing, that this, if the growth rate is equal to cost of equity, then what will happen to P0? It will be infinite. Last time also I asked this question to you and I got disconnected. I'm again not getting your replies. Am I still disconnected? Oh yes, infinite, that's right. What if the growth rate is more in this formula? In that case, the denominator will be negative and the value will also be negative. Now, the share value cannot be negative. So I can conclude that this formula will fail if the growth rate is equal to or more than cost of equity. In real life, this situation never arises that growth rate is equal to or more than the cost of equity. So here comes the most important approach. The previous three approaches, the constant dividend, constant earning, and the constant growth approaches are actually valuation approaches which are used to calculate the cost in a reverse fashion. But this capital asset pricing model, which you study in portfolio management also, and I told you about this formula while studying time value of money also, is the original formula to calculate the cost. It is not a reverse calculation. So your expectation from any investment is minimum risk-free rate of return plus what do you wish is risk premium. And the risk premium is equal to risk premium on market portfolio, that is RM minus RF. Look here, RM is market return, RF is risk-free rate of return, RM minus RF is risk premium on market portfolio, and this should be multiplied by beta, which is the risk index. If beta is 2, it means the volatility or risk in your share is double as compared to the general market risk. Okay. So this is the original formula to calculate cost of equity. The remaining three formulas were just, reverse formulas. Okay. Once you calculate, you have learned to calculate cost of debt, cost of preferentials, and cost of equity shares. Now here comes the concept of cost of retained earnings. Retained earning is also a source of finance. And who is owner of retained earning? Equity shareholders are owners of the retained earning. That's why the cost of equity must be equal to cost of retained earning. But practically, cost of retained earning is slightly less than cost of equity. You know why? In case of equity shares, besides expectation of investors, you have to bear issue expenses also. Brokerage, underwriting, prospectus expenses, fees of merchant banker, etc. But in case of retained earnings, no issue expenses are involved. So formula for cost of retained earning is same as formula for cost of equity. Under dividend capitalization approach, it is D upon P. Under earning capitalization approach, it is EPS upon P. Under growth approach, it is D1 upon P0 plus G. But the difference is in KE formula, P is equal to issue price minus issue expenses. See, cost of equity, when you take P, is issue price minus issue expenses. But when cost of retained earning is calculated, you take P equal to simply current fair value or current market price. You don't take issue price because you're not issuing anything. You don't deduct issue expenses because you won't have to bear issue expenses. This is how you can calculate, the cost of equity. Then there is the weighted average cost of capital or the overall cost of capital. I calculated individual cost, but I cannot say that I have calculated cost of debt, cost of preference share, cost of equity share, cost of retained earning, cost of bank loan, and cost of GDR, cost of ADR. I have calculated cost of 7 sources of finance, but I cannot say that I will procure entire amount from the cheapest source, because besides cost, I need to consider control and risk also. And that's why I prepare a mix of various sources of finance. And that's why I need to calculate weighted average cost of capital. How do I calculate average cost of capital? It's very simple. You take individual cost, multiply it by the respective weight, and then make a sum total. And divide this by sum total of all the weights. The weights may be of two types. Either it can be a book value weight, like the balance sheet value of debt equity preference, or it can be market value weight. Market value weights are always preferable over book value weights. Why market value weights are always preferable over book value weights? Reason is quite simple. You calculate cost using market value. Therefore, while assigning weight, there you should also assign market value. That is the total cost of capital. What if I am interested in calculation of marginal cost of capital? Marginal cost means the extra fund I am going to procure. Already I am using 100 crore in my business, which includes debt, preference, equity, reserves, bank loan, project finance, etc. 100 crores. Now I am going to raise 10 crore rupees extra. And for that, I'll be using only two sources. One is the foreign debt and number one is foreign equity. So if I'm trying to figure out cost of this additional fund, that is named as marginal cost of capital. Okay, just give me one moment, so that I wanted to share one more file with you. Oh, I'm sorry, the sharing is stopped. Wait a minute, please. Give me 2 minutes. Just a minute, please. Okay, fine. Now I got that file. All right. So guys, now some of the, yeah, once, okay. So there are two ways in which you can take your capital structure decisions. Say you have been given two or three capital structures. So you calculate the cost of individual sources of finance, and thereafter you can, I'm sorry, you calculate the cost of individual sources of finance, and thereafter you can calculate the weighted average cost of capital for each of the alternatives. Once you are able to figure out the weighted average cost of capital for option 1, option 2, option 3, then choose the capital structure which has the lowest cost of capital, weighted average cost of capital. But that is all again not going to consider the risk involved in the capital structure. If you choose a capital structure which has higher amount of debt, then you will have higher financial risk. And in case of higher financial risk, your market value will actually reduce. So therefore, one should not take capital structure decision on the basis of weighted average cost of capital alone. Rather than one should consider income part also. So your business need 100 crore rupees of fund. Two capital structures are available to you. Says entire amount by issuing equity shares. Second capital structure is 50 crore rupees of equity and 50 crore rupees of debt. That way, total 100 crore rupees of fund should be raised. Okay. Don't simply take decision by calculating weighted average cost of capital. Rather than you should also consider the income which you will be earning in your business. And now that is named as EBIT EPS analysis. That is, you start with EBIT for each capital structure, then deduct interest to arrive at profit before tax, then deduct tax to arrive at profit after tax, then deduct dividend on preference shares to arrive at earning available to equity shareholders, then divide it by number of equity share to arrive at earning per share. Either you can take a decision over here or you can multiply it by price earning ratio to arrive at market price per share. One such example I have already given to you in the form of financial leverage. Look here, I will just copy and paste this example again for you. Wait a minute. Okay, let's consider this here only. So what I'm saying, don't calculate weighted average cost of capital of plan 1, 2 and select the plan which has lower WACC. Rather than you should consider EBIT also. You start with EBIT, then you deduct interest to get PBT, then you deduct tax to get PAT, then you divide it by number of equity shares to get earning per share. Okay, now let me ask you one question. What is the basic objective of financial management? Can you tell me? What is the basic objective of financial management? The basic objective of financial management is to maximize wealth. Wealth maximization is the objective of financial management. And wealth means the market value. If the market price of your company's share rises, it means that your wealth is actually rising. And what is wealth? Wealth is market value. What is value? Value is equal to performance divided by expectation. So this is actually the performance of the company. What about expectation? So now I will divide it by cost of equity, say KE. Suppose cost of equity, in both cases, it is say 12.5%. Say, for example, in both these cases, cost of equity is 12.5%. Now try to recall the earning capitalization approach formula. P is equal to EPS divided by KE. So market price is equal to EPS divided by cost of equity. So here the market price per share will be 7.2 rupees. And in the second case, it is 9.6. Okay, let me change example to some extent. Just a minute. I'm making some changes in example so that it looks a better example to explain. Okay, I made some change in the example. So ROI is 25%, EBIT is 50,000 rupees, tax rate is just 20%, and EPS is 1.5 and 2.4 rupees. And cost of equity is, it is 12.5%. That is, expectation of equity shareholders is 12.5%. And this way, the market price per share is 12 rupees and 19.2 rupees. And now you have to take that. This is called EBIT EPS analysis. Allow me to title it as EBIT EPS analysis. So how do you take a decision in EBIT EPS analysis? You will choose the plan which has higher market price per share. Observe one thing over here, that cost of equity is same under both plans. So one can take decision even on the basis of EPS. If question is silent regarding the cost of equity, you can assume that cost of equity will remain same for all available options. And therefore, I will choose the option which has higher EPS. If EPS is higher, market price per share or fair value per share will automatically be higher. Okay. Now, some people do one thing. I'll tell you two formulas. The formula for P is like this. The fair value of a share is equal to EPS divided by cost of equity. If I rewrite this formula actually becomes KE is equal to cost of equity is equal to EPS divided by MPS. This is the earning capitalization approach formula for cost of equity. And if you know the price earning ratio formula, the price earning ratio formula is market price per share divided by earning per share. Moral of the story, that PE ratio is actually equal to 1 divided by the cost of equity. P ratio is equal to 1 divided by the cost of equity. So here, if I do 1 divided by 12.5%, I'll get 8 times, simply 8 as my price earning ratio. That EPS is 1.5. I'll copy it here. EPS is 1.5 and 2.4. Then rather than dividing by cost of equity, I'll multiply it by the PE ratio, that is the price earning ratio, to get MPS. So MPS will be EPS multiplied by the price earning ratio. There are two ways of doing it. You come up to EPS, then either you divide it by cost of equity to get MPS, or you multiply it by price earning ratio to get the market price per share. Okay. This is quite obvious that P ratio is MPS upon EPS. It means that EPS multiplied by PE ratio will be equal to MPS. Now I'm repeating, if the question has not given you cost of equity or price earning ratio, you can assume that it will be same under both options. Hence you can take decision on the basis of EPS only. But if question gives you cost of equity or price earning ratio, then apply it and then come to MPS and then give a conclusion that plan 2 is better than plan 1. Okay. But, why plan 2 is actually better than plan 1? The reason here is quite obvious. Here ROI is 25%. And if ROI is more than interest rate, then you get advantage of trading on equity. If ROI reduces drastically and say ROI becomes just 5%, it's too less. Let's say 6% or maybe 8%, then see what will happen. Now EBIT is not 50,000 rupees for both plans. It is now 16,000 rupees. And then I calculate PBT, and then I calculate PAT, and then I calculate EPS, and now you can see the thing has just reversed. When ROI was huge, 25%, in that case, plan 2 was looking much more attractive. But if ROI reduces drastically and comes down to 8%, now you see that MPS under plan 1 is higher than MPS under plan 2. So there must be some EBIT. At 50,000 EBIT, plan 2 was better. See, I'll again show it to you. See, at 50,000 EBIT, plan 2 is better. But at 16,000 EBIT, plan 1 is better. So what is the EBIT at which both the plans will give equal result? And actually that is named as indifference point. See, if EBIT is 20,000 rupees, both the plans have equal EPS, hence equal MPS also. And this level of EBIT is actually named as indifference point. In a simple question, you can say if ROI is equal to interest rate, see here interest rate is 10% and ROI is also equal to 10%. If ROI is equal to interest rate, in that case, there will be indifference. That is whether it is the pure equity plan or it is the debt plan. In both cases, I'll be getting the same result. So let me give you one definition quickly, and that is obviously the indifference point. And break-even point. Oh, I'm sorry. What is indifference point? Indifference level of EBIT at which EPS is equal to 0. No, EPS is same under two financial plans. Look here. If EBIT is 20,000 rupees, both the plans have same EPS and you can choose any one of the two plans. Indifference point is 20,000 rupees of EBIT in this case. If EBIT is more than indifference point, then debt plan is better, higher EPS. If EBIT is less than indifference point, then equity plan will be better. Level of EBIT at which EPS is equal under two financial plan is named as indifference point. The plan which has more equity may be named as equity plan, and the plan which has more debt may be named as debt plan. If EBIT is more than the indifference point, it means your ROI is more than interest rate, then you will be getting advantage of trading on equity. In that case, the debt plan will have higher EPS. If EBIT is less than the indifference point of 20,000 in that example, then your ROI is less than interest rate. And if ROI is less than interest rate, you get disadvantage of trading on equity. And that way your debt plan is disadvantageous and therefore equity plan is better. So why do we get indifference point at all? The reason is quite simple. Say your EBIT is 30,000 rupees and you take a decision, you give a decision, plan 2 is better than plan 1. You give a decision that plan 2 is better than plan 1. But at least you should know that today this is good, but tomorrow if EBIT fluctuates, my decision can go wrong. So what is the indifference point? Indifference point in this example is 20,000. Currently, you are expected to earn 30,000. So here, debt plan is good. Debt plan here it is good, here also it is good, here also it is good, here also it is good. And here, both debt and equity will give you same result. And if EBIT reduces below this indifference point, then the debt plan will be disadvantageous and equity plan will become better. So that's why you're giving the decision, fine. But at least you should know the margin of safety of your decision. And that's calculate indifference point. Then what is financial break-even point? In indifference point, you are trying to make EPS of the two plans equal. In financial break-even point, you are trying to calculate the level of EBIT at which EPS will become zero. At financial break-even point, making a calculation by simply looking at these figures, I can tell you financial BEP. In plan number 1, at 0 EBIT, EPS will be 0. See, if I put 0 EBIT, EPS is, there is no obligation of interest. So if I earn 0 EBIT, my EPS will be 0. But in debt plan, 0 EBIT will give negative EPS because I have the obligation to pay interest. So I'll have to earn at least 10,000 rupees of EBIT so that I can pay interest to get 0 EPS. So this 10,000 is financial BEP. For equity plan, financial BEP will be lower. For debt plan, financial BEP will be higher. In debt plan, even to give 0 earning per share, you will have to earn huge amount so that at least you can pay interest and dividend preferentials. Higher the financial break-even point, higher the financial risk you will have to bear. Higher the financial break-even point, higher the financial risk. So while taking decision, you keep in mind 3 things. Number 1, the EBIT EPS analysis, that is calculation of EPS and MPS. Number 2, indifference point. And number 3, financial break-even point. Okay. So this is about your cost of capital and capital structure decisions. Now, the next thing we are going to discuss is capital structure theories. That is net income approach, net operating income approach, Modigliani and Miller approach, and the traditional approach. Okay, before we proceed, just feel free to ask if you have any doubt. You know, the time is very limited and syllabus is huge. And that's why I'll have to rush kind of through some of the concepts, assuming that you have already studied it and not studying it for the first time. Capital structure theories. There are 4 popular capital structure theories. The net income approach, net operating income approach, Modigliani and Miller approach, and the traditional theory. So let's start with the net income approach. What does it say? There are some assumptions under the net income approach. You see this diagram. On x-axis, I have taken debt equity ratio. On y-axis, I have taken cost of capital. Okay, dividend distribution tax. There is one doubt from Sakshi. Look, now dividend distribution tax concept has been abolished by government. So now dividend is taxable in the hands of investors. And therefore dividend distribution tax need not to be considered. But you know, if you say, no, I am doing calculation for last year or before last year, then how do I account for dividend distribution tax? That's quite simple. Say your amount of preference dividend is 1 lakh rupees. Suppose the amount of preferential dividend you are going to distribute is 1 lakh rupees. And dividend distribution tax is 15%. So first you type 1 lakh rupees on your calculator. This is the amount which you are giving to preference shareholders. Now divided by 0.85 because DDT is 15%. So you need to divide it by 0.85 and then multiply it by 15%. And you will get 17,647 rupees. That will be the amount of dividend distribution tax. So 1 lakh rupees you give dividend and 17,647 you are giving tax. In total, your total amount is 1,17,647 rupees. So wherever you put dividend on preference share, don't put 1 lakh rupees. Rather than you put 1,17,647. Whether it is for calculation of DFL, or it is for calculation of EPS, or it is for calculation of cost of preference share, at all places, put preference dividend equal to 1,17,647 and not 1 lakh. But that is history now. Now dividend is taxable in the hands of, and dividend distribution tax has been abolished. Okay, let's get back to the chapter, capital structure theories. A question arises that why at all this capital structure theories chapter is required. Look, the concept is very simple. You know, there are 3 things to be considered while you take the capital structure decision. And those 3 things are risk, cost, and control. If you borrow more, risk will rise. But if you issue more equity share rather than borrowing, then the control will be lost. And the third thing is cost of capital. You should design your capital structure in such a manner so that it reduces your overall cost of capital. Okay, answer me one thing. Usually, what is higher? It is the cost of debt, which is usually higher, or is it the cost of equity, which is usually higher? Can you tell me? Oh, I'm getting one answer as cost of debt. No, usually cost of equity is higher. Reason is quite simple. Equity shareholders are owners of the company and they are bearing the whole risk. They get money after the return is given to all other people. So equity shareholders have to take a huge amount of risk and debenture holders have to take comparatively very lower amount of risk. And that's why the expectation of equity shareholders remains higher than the expectation of debenture holders. And that's why the cost of equity will be higher than the cost of debt. On the top of it, you get a tax benefit. So the cost of debt will further reduce. And there will be a big gap between cost of equity and cost of debt. So now I'm giving you 2-3 minutes time. Just observe this on the screen, that what is net income approach, and then I'll let you know it. Okay, have you got it? Look, on x-axis, I have taken debt equity ratio. On y-axis, it is the cost. So what I'm trying to analyze is it does the overall cost of capital reduce when I introduce more debt into the capital structure? So there are some assumptions under NI approach. Cost of debt remains constant with increase in debt equity ratio. I am borrowing 1 lakh rupees, interest rate is 10%. Now I borrow 5 lakh rupees, still the interest rate will remain 10%. It's like this. Okay. Look here. The cost of debt remains constant. Okay, I'll reduce this 1, 2, 3, and 4 things. Now it will be easy to observe. Second assumption which is taken is, oh, I'm sorry. Yeah, screen is invisible. Just give me one moment and I'll fix it. Okay. Yeah, it is visible now. So cost of debt remains constant with increase in debt equity ratio. If I borrow lower amount, interest rate is say 10%. Even if I borrow higher amount, interest rate will be 10%. Look here, this diagram. This cost of debt, KD, it's a flat line. It means that the cost of debt remains constant. Cost of equity also remains constant with increase in debt equity ratio. Now, this is a kind of big assumption. They are assuming that even if you keep borrowing higher amount, expectation of equity shareholders will remain the same. See, the cost of equity, it is flat. It is not increasing. Number 3, cost of debt is less than the cost of equity. And that's quite a reason that yes, cost of debt is usually less than the cost of equity. Now KD is constant, KE is constant, KD is less than K. One expensive source, cost of equity. One cheaper source, here I pay cost of debt. So if I increase the proportion of if I increase the proportion of debt in my capital structure, if I increase the proportion of debt in my capital structure, then the overall cost of capital will keep reducing because the cheaper source has got more weightage in capital structure now. See here at this point, the overall cost of capital and cost of equity are exactly same because here the debt equity ratio is 0, and if the debt equity ratio is 0, then overall cost of capital is equal to the cost of equity. But with increase in debt equity ratio, overall cost of capital will reduce. So moral of the story, as per NI approach, I'm not saying this is the final conclusion. As per net income approach, the conclusion is like this: more and more debt in your capital structure. It's not my conclusion, it's not chapter conclusion. As per net income approach, you should have more and more debt in your capital structure, and that way your overall cost of capital will be on the lower side. Here we have assumed that there is no income tax, but if we apply income tax, then situation will change further. How does it change? I'll tell you. See here, if I say that there is income tax, then this cost of debt line will shift further down. Cost of debt line will shift further because KD after tax will be less than the KD itself. And therefore, the overall cost of capital, it will see a rapid fall. See, the dotted line is the with tax situation. The KD is further less, and that's why the overall cost of capital also reduces faster. And this net income approach is giving a kind of conclusion to us that yes, you should borrow more and more amount. This is the graphical presentation, but if I take it with one example, say my capital employed is going to be 2 lakh rupees, the cost of equity is 12.5%, ROI is 15%. If the capital is 2 lakh rupees and I'm earning 15% ROI, it means that I'm earning 2 lakh into 15%, that is 30,000. I have two options to raise the fund. Option one is equity share capital 1 lakh and debt capital 1 lakh, total 2 lakh. Option two, you reduce equity to 50,000 rupees and you increase debt to the level of 1,50,000 rupees. Okay. Now let's evaluate under net income approach, which option proves to be better. EBIT is 30,000. How can you have same EBIT for two options? Should not it be different? Shouldn't we have two different EBITs for two options? Second option has more debt. So its EBIT should be more or should be less? Or let me ask it this way, is EBIT dependent on capital structure? Exactly. EBIT means sales minus variable cost minus operating fixed cost. So EBIT is not dependent on capital structure, and that's why EBIT is same. Then I deduct interest at the rate of 10%, which is 10 and 15,000. So I come at earning available to equity shareholders, which is 20,000 and 15,000. Now I don't calculate per share figure. I keep it, total. I keep it in total amount. I don't calculate per share. Usually what do? I do EPS divided by cost of equity. But here I'm doing whole earning divided by cost of equity. So that will give you the whole market value for equity. 20,000 divided by 12.5% is 1,60,000, and 15,000 divided by 12.5% is 1,20,000. So we got market value of equity. Now I add market value of debt to it, which is 1 lakh and 1,50,000. We are assuming that debt is quoted at par. Total value of the firm is 2,60,000 and 2,70,000. Now there is then I calculate overall cost of capital. Overall cost of capital, if I'm trying to calculate, so KO is equal to KD. In this case, KD is 10%. Have you observed that I have ignored tax? We have assumed that there is no income tax. Cost of debt is 10% multiplied by amount of debt is 1 lakh. Plus cost of equity is 12.5% multiplied by amount of equity is 1.6 lakhs. Okay. And then I divided by total of the weights, which is actually 2.6 lakhs. So the numerator here will be 12.5 into 1.6 plus 10, 30 divided by 2.6. Calculate this. So 11.54%. This is the overall cost of capital. In second case, it will be 10% into 1.5 lakh rupees of debt plus 12.5% into 1.2 lakh rupees of equity. Total 2.7 lakhs. So in the numerator, it will be 12.5 into 1.2 plus 15, that is 30 divided by 2.7. So this is the proper method. And you know, the shortcut is overall cost of capital is EBIT divided by value. So your EBIT is 30,000 divided by value is 2,60,000. $30,000 divided by 2,60,000 is 0.1154. That is 11.54%. And in the second case, EBIT divided by 2,70,000. So that will be 11.11%. So the shortcut is EBIT divided by value. And moral of the story, option 2 has lower weighted average cost of capital. You know why? It has higher amount of debt, and debt is cheaper. So when you increase the proportion, cheaper source in your capital structure, your overall cost of capital will actually increase. Increase or reduce? No, it will reduce. You know, the expensive, the cheaper ingredient is water. So the doodh wale bhaiya lives at your home. If you mix some water in the ratio of 1:1, half liter of milk and half liter of water, his overall cost of producing and giving the milk to you. So if the proportion of cheaper source is increased, then the overall cost of capital reduces. This is the conclusion of net income approach. Now the net operating income approach and Modigliani approach and the traditional approach, that we will study on 6th of July. So on 6th of July, our agenda will be to start with this capital structure theory's remaining part, because Modigliani and Miller approach is especially very important. And then we will proceed for working capital management and dividend policy decision. So today's session was scheduled up to 10:45 only, because this is the message I got from ICSI. All right then. So see you in the next session. Please cover derivative and forex as well. No, there is some confusion. Derivative and forex is being covered by other faculty. Okay, I cannot take that. It has not been allotted to me. Thank you, most Riksha and Anisha and all other people. All right. Bye-bye. Thank you. Take care.